Disgusting out here or what? Holy moly. I was able to come out here without an umbrella for the time being because it is nasty in San Diego today, boy. Let me tell you something. But all rainy, all muddy out here in San Diego. Nice and chilly, little cold, little rainy out here in San Diego today. That's for sure. But of course, this is physical and financial fitness with Patrick, and I come here live every morning to motivate people to get in their best shape ever, physically and financially. So we have a live Q&A here in the mornings on my YouTube channel, 6:30 to 8 a.m. And I figured if I'm going to be working out in my dungeon garage gym, I might as well offer some value and talk with you fine people on YouTube daily. So if you're on here, good morning. Pop a good morning or a what's up in the comments, and let's get this going here this morning with some algorithm love. So say hi, let me know where you are right now listening in from. Are you across the United States? Are you across the world? Or are you right here in California with me? Let me know. Say what's up in the chat. Good morning, good morning. What's up, brother? All right, we got Chase Young on here. Chase, are you going to work out with me today, or are you just going to be doing busy work and asking some questions? Are you going to be lifting this morning? I'm always eager now to find out if I can accumulate some lifting friends or some lifting buddies. I'm trying to get my friend Nick Martin made a mistake the other day and told me, man, I really want to get my morning routine back in action, and I really need to start lifting, man. I really need to. And I go, dude, I'm your buddy and I'm your accountability system. I'm going to be there every morning on YouTube. So hopefully soon enough, I'm going to start collecting some friends that actually would like to work out with me, and I can be their motivation to get moving in the mornings, right? So that's a couple things I do, guys, is I'm going to get you moving in the morning, and I'm going to hopefully try to be motivation for you to get in your best shape ever, no matter where you're starting from physically and no matter what age you are. Get in the best shape ever. Chase Young eating breakfast. Let's go. Then gym time. Today is my my worst, most hated day in the gym, Chase, and that's why I am wearing my Nope shirt, because this is one of those days I usually go, maybe I could skip the workout. Nope. Maybe I could just stay in bed where it's nice and warm and not freezing cold in my dungeon garage gym. Nope. So that's why I'm wearing my Nope shirt today, because guess what? Nope, you can't skip abs, and nope, you can't skip legs. You can't skip leg day. So anyway, man, today I got to do legs and abs. But since those of you who know me really well know that I have a pretty bad knee with 3 surgeries on it, no cartilage, my doctor says I'm not really supposed to do much leg workout. Like, I'm not supposed to do actual squats and stuff with an Olympic bar, but it's okay. It's okay. We work through it. I'm also not supposed to walk an 18-hole golf course and walk it either. So you know what doctors say. Doctors say one thing and you do the other. It was funny when George Burns, they said, to George Burns, you're like 90 some odd years old, man. Doesn't your doctor tell you need to stop smoking those cigars? And he said, all my doctors are dead. So there's a good point there. But anyway, I digress. We're going to do some legs and some abs today, which is my most favorite day, of course, in the gym. It's just fantastic. I just love legs. I love doing abs. But I do have y'all set up screen share on my flat screen TV, so I will be able to see your comments from afar. So I won't be quite as close on camera today as I normally am sometimes. But that's okay. You guys can ask questions. I can see from afar, and we can do some Q&A. Hopefully either you're working out, getting in your best shape. I'm a motivation to get you to do that. Or, like I said, I'm open to being on here live YouTube in the mornings to answer questions that people may have about certain types of investment categories or financial freedom, cash flow notes. We got the Cash Flow Conference at Sea coming up. The Cash Flow Conference at Sea is a badass real estate conference at sea on a Cabo cruise. That's coming up. You guys know I specialize in mortgage notes. You guys know that I'm building these apartments in Florida. And I always just preach to people about financial freedom, passive cash flow. and how to kind of break out of this financial matrix we're in, because guys, there's a way that you can break out of being unhealthy. There's a way that you can break out of being too fat, overweight, these kinds of things. You can break out of that on purpose, just like you can break out of being broke. You can break out of a thin pocketbook. And both, as you would assume, this is kind of why I do physical and financial fitness in the mornings, is that both the financial and the physical, guys, both are not overnight things that happen. And of course, some people win the lottery and all that stuff, but I'm just saying, generally, it's not an overnight thing that happens, either building physical change or financial change. It's oftentimes, guys, becomes a systematic approach. Okay, an intelligent, systematic approach in which you give it time and consistency. And that's, of course, how most of us change physicality and most of us change, financial. So, that's why I come on here and talk about both of those subjects, guys. It's like, never an overnight win with finances or fitness. We've got to stay consistent, and we've got to create systems and structures that allow us to make progress in both areas. So today, I sometimes I come with a subject to talk about, whether I'm talking about notes or the cruise or our fund or passive investing. Yesterday, I think we talked about private lending and the beauty of private lending and how wonderful private lending is as an investor. And so, anyways, today I was going to leave it a little bit open. Just for some Q&A. Mr. Info Marketer is on. I think that's Jamal. But yeah, good morning. You've been lifting, upper lower split. What's your workout routine? I do this every day, 5 days a week from out here, Jamal. So we've been doing chest and shoulders. And yesterday we did pulling exercises. And so yesterday we did bench or what? No, yesterday we did lat pull down, seated rows, upright rows, curls, those kinds of things. So today we're just going to do some light stuff. So I'm going to have a lot of time to pay attention to you. I'm just not going to be close to the camera, but we're going to do some abs today. We're going to do some simple legs, guys. I have a knee injury. It's really bad. So I don't really do crazy heavy stuff with the legs these days, but I just don't skip leg day, period. We can't do that. So, Andy, congratulations for busting out a 4-mile walk this morning at 4 a.m. and ready to make calls. Andy's on it, man. Andy is on it. So today we do legs and abs. So I'm just going to do some leg extensions on my janky little leg extension bench here in my dungeon gym. We're going to do some hanging leg raises for some abs. I'm going to throw on an Olympic bar, and we'll probably do some pretty light squats. We'll do some hamstring curls and that. And then maybe after I get off, I'm probably going to jump rope for about 10 minutes just to get some cardio going. But of course, I won't be jumping the rope while I'm on here talking with you fine folks, because I already get out of breath as it is doing sets, but jumping rope would be difficult for me to talk with you guys. So I'm kind of going to leave it open today a little bit. Rather than me come with some sort of a pre-designed subject to speak on, I thought we would just wrap it today and just wrap back and forth. And you guys can tell me what it is that you guys want to discuss. But of course, you guys know my areas of expertise. My areas of expertise are mortgage notes, passive cash flow, running an investment fund, apartment development, life insurance, dynasty trusts, asset protection, some cryptocurrencies that I've been studying and investing in for some time. And so, maybe there's infrastructure questions, or maybe you have questions about something that's off base today. But I'm going to kind of leave it open, man. You guys know that it's raw and uncut here. I've been coming with subjects to speak about because my YouTube lives in the morning like this are fairly new. So when they're fairly new and people don't know me or know how I roll, people don't know what to ask me. So I've been coming with these like preemptive subjects in the mornings. And today I didn't come up with one. I just didn't. So that's how raw this is today. I'm just going to leave it wide open for all of you guys to chime in. And if you guys have anything that you guys want to talk about, or any curiosities or questions you have, whether it be fitness or finance related, let's chop it up. I know Jamal hasn't been on here very long. So Jamal, I come here live in my garage. It's like my little garage gym. I don't like going to the gym. I used to go to the gym a lot when I was younger. I just don't like going to the gym now. I like to just be by myself and do my own thing. And so I built like this little tiny garage gym. It's like in about a 12 by 12 area. and I have some very small pieces of equipment, some benches, some dumbbells, this Makolo system that we bolted to the wall right here that's very small and folds up and that. So I try to get this little productive gym area um, in a very small space that I can just come down here in the mornings and get my stuff knocked out. And what I was doing was I was down here, guys, and this you may want to try to do. And I know a lot of you guys are doing this with me. Is that you may want to try, in the mornings when you're working out or whatever you're doing, just listen. I used to listen down here to other people's content. So for the last like year and a half, I was coming down here in the mornings, getting back my fitness, getting back to working out, and I would listen to other people's podcasts, and I would listen to all sorts of things, educating myself on the financial structure of the world, fiat currency, cryptocurrency, all sorts of different real estate techniques. So I would just listen to other people's stuff down here while working out. It was great because in the last year and a half, I have learned a lot. Okay. So it's all good. What I finally decided to do was, you know what? Since I'm down here in the garage anyways, and I'm consistent with that because I want to try to get in better shape physically myself. And so I'm holding myself accountable to do some exercising in my garage in the mornings. So, you know what? Why don't I start to go live on YouTube or something like that? And then I'm going to try to give some nuggets or try to help people with some content versus listening and soaking up everybody else's. So right on. We are here today. Andy's in. Andy's a stud, man. Andy is a stud. Andy went for a 4-mile run today already at 4 a.m. And he's ready to make calls, ready to crush it in business today. Chase Young, how do you go about setting up a trust? That's pretty simple, man. What you'll find out with a lot of these complicated things, like somebody asked me a couple days ago, how I know how to foreclose on somebody. They're like, well, how do you know all the procedure to foreclose on somebody? And I'm like, well, if I do a foreclosure in the note investing space, I don't do the foreclosure, right? And same thing with with the trust, Chase. How do you go about setting up a trust? Which I recommend everybody does. Everybody should be operating out of a trust, period. So good call on that, Chase. You want to hire a trust attorney, of course. You get with a trust attorney in which, you're a homie of mine. I have a good trust attorney. His name's Justin, who does our family trust and stuff like that. But it's all about scratching a check. Like same thing, right? I scratch a check, write a check to a trust attorney, and they'll set you up the right trust based on your needs. And same with a foreclosure attorney. I have to write a foreclosure attorney a check. And it's funny, when you pay them, they work for you. When you pay them, they work for you. So I would set it up with a trust attorney. I have a trust attorney if you need a good recommendation of one that set up our family trust and our dynasty trust, both. And what assets would I recommend putting in there? Depending on, how one lives their life and what their future goals are, and if they have family and kids and those kinds of things, it all kind of compiles into what you really want to do with the trust structure. But I'm a big believer on operating out of a trust. And when I say operating out of a trust, I say I'm a big believer in trying to do as little operation out in public as an individual person as you possibly can. I would try to do as little, if nothing, as an individual person, meaning you shouldn't own your cars. You shouldn't own your house. You shouldn't own your artwork. You shouldn't own your Rolex watches. You shouldn't even own your cryptocurrency, if that makes sense. You, as an individual person on paper, shouldn't own that stuff. It should all be owned by a trust. And you guys know why, right? You guys know why. Can you guys give me a reason why? So I'm not on some sort of an educational rant today. I want this to kind of be participatory if you guys have the time to type it in the chat. I know that's a pain in the butt to do too, but yeah, I mean, look, let me ask you this. If somebody comes, if something happens in your life and you get sued, someone's going to come after you, right? Maybe you accidentally got in a car crash on accident or something like that. But anyways, doesn't matter. Someone's coming to sue your butt. Okay. Well, all the attorneys can do is look at somebody and try to assess what they have to go after, right? So if we get sued, we aren't personally liable. There you go. Mr. Info Marketer, which I think is Jamal, but it's all good. Like, look, if somebody's going to come sue you for something and they try to find out what you own, right? and on paper, you're not listed as the owner of anything, then what do they sue you for? It kind of puts the attorney in like an interesting spot, right? They got to go tell their client, man, hey, I'm afraid to tell you that, you want to go after this guy and you want to sue him and stuff. And fair enough, but the guy's got nothing. So what are we supposed to sue him for? What are we going to take? His socks and his shoes off his feet or something? So yes, it's to protect your assets. So it's a shroud or a shield or a cage or however you want to look at it mentally, right? You're protecting and putting your things of value into an entity of ownership in which is outside of you. And so you don't own it. You don't own it. You can't be sued for it. Yeah, right, Chase. But you don't use those things anymore, bro. I'm just playing. Yeah, no doubt though. Don't take the golf clubs, right? So good point. Can your golf clubs be owned by the family trust and you be the beneficiary of the family trust? Being the beneficiary means that you get to utilize the things that are owned by the trust. So could your trust own your golf clubs, and could you still have them in the trunk of your car, and could you still be playing golf with them every week? So that's kind of the interesting point people don't get, right? Is that when the trust owns your stuff, it doesn't mean that you're not able to use it full time. There's trustees and there's beneficiaries of the trust and things like that. And you look up those terms, you'll find out what abilities the trustees have in controlling the assets in there. So, if a trust owns a Rolls Royce and I'm the trustee, I can drive the Rolls Royce around. If the trust owns anything, you have access to it. If I was 40 years old, and I'm not, well, you got to tell your age now, Andy. But if you were 40 years old, but let's see, I can't read that real quick. But if you were 40 years old and you had a 401k losing money because of the stock market, what would be an alternative for you? That's a good question, Andy. What you'd really first have to look at is the ability of what you can do or can't do with your 401k. 401ks are quirky in that manner, and just being the fact that if you're still working for the company in which you initiated the 401k with, you may not be able to do much with that 401k. You may have to wait until you're either no longer an employee there with that company to do anything with that money. But, look, the bottom line is this, guys. I think what Andy's asking is, what do you do if you're behind schedule? He's 40 years old, has maybe a 401k that's not doing great. And if he's losing money because it's in the stock market, then probably he's looking, like he said, for an alternative. So Andy's going, what can I do besides the stock market? And especially, are there opportunities for what else can I do with my retirement? Once people get to like 40, 50 years old, people start thinking about retirement more so obviously than when we're younger. So it gets to be more important, or more weight on your mind when it comes to retirement. Am I headed the right direction? In 20 years from now or 25 years from now, if you're 40, you're saying in 20, 25 years from now, am I going to have enough money to retire? Am I going to be able to pay my bills? Am I going to be able to stop working and, actually retire and not have to go 40 hours a week at a job when I'm 70 years old and that? And, the answer is most people aren't in good shape in those manners. Most people are retiring fairly broke. Most people don't retire with a lot of money. I want you guys to think of this, and I'm going to get to answering your question, but think of this. This is crazy, right? If you have $1 million, just do the math. If you have $1 million when you retire, which most people don't have, but I'm just saying, if you have $1 million when you retire, and you are able to put that to work at 5%, because let's just say people are looking at normal average returns that are very safe, maybe diversified across the stock market type returns. The S&P 500 is like at 9% or whatever, year over year. So, let's just say that, okay? Say 13 in the chat. Can we all like this video? It helps Patrick. He's a great guy. Thanks, AJ. That's super nice of you, dude. But anyway, so if you have $1 million when you retire and the $1 million works for you at 5%, that's going to earn you $50,000 per year. So 50 grand a year is what you'd earn on a, return wise on $1 million working for you at 5%. You got 50 grand. Okay. 50 grand a year. So if you have $1 million and it's working at 10% per year, then you have 100 grand a year. You guys see what I'm saying? To live off of, right? To live off of. So that's normally not enough. Of course, as things expand as far as inflation is concerned, as properties get more expensive, cars get more expensive, eggs get more expensive. I mean, it's crazy, right? So as that happens, of course, it becomes harder and harder for people to live off of and pay all their bills with something like 50 grand a year. And then the cost of medications when you get older and all this other stuff, right? Medical bills and things. So it's like it's very, very difficult to live on 50 to 100 grand a year, depending on where you live, but most people don't even retire with $1 million. So what can we do is what Andy's saying. Andy's saying if we're 40 years old or we're getting older and we're not, set forth on our retirement goals, would be the same thing to say, kind of the same thing to say, guys, if I was 40 years old and I was starting to get in really bad shape or I was starting to accumulate a big old beer belly, how do I fix this, man? I see I have a problem here. I don't want more time to go on and just continuing the same problem. I got to fix it. So that's what we'll talk about real quick, Andy. We'll talk about fixing it. So how do you fix this? You're 40 years old, you're 50 years old, you're not quite ready to, you're not quite comfortable, I guess I should say. You're not quite comfortable with your position financially. You're looking at, say, man, I might not be retiring too fat here. This is kind of scaring me, right? So what can we do? Well, here's what we can do. First, we can make a mental commitment to change the situation, can we not? First, we can make a mental commitment to change the situation and start to do something about it, okay? That's the first thing. And then we have to understand that people that, it's going to be tough doing those while I talk to you guys, leg raises like that. But it's going to be tough for people to understand the systematic and monotonous approach and that it takes to get in shape or to build wealth. And most people are not patient enough to get through the systematic approach. People want to see change immediately. So just like in retirement, we're not going to go all of a sudden from our pocketbook or our retirements being completely out of shape to all of a sudden, benching 400 pounds the next week. Okay. It's not how it's going to happen. Just like it doesn't happen that way with your body. It's a slow progression and a systematic approach. But what you can do, Andy, is this. At 40 or 50, we're not, of course, in our 20s anymore. When we're in our 20s, it may make more sense to be doing risky things. Just like me, there's so many correlations, right? But just like in our 20s, when we used to lift weights, we used to be able to go for 1 rep max and lift stuff so heavy that we couldn't lift it. We needed 5 spotters to get it off of us, but we would never have an injury. So we were able to play that game back then. When you get to 40 or 50 years old, I suggest not lifting like that anymore because you're going to pull something and you're going to bust a shoulder or you're going to snap a bicep or you're going to, who knows what, dude. But the bottom line is we can't run fast at it. Okay. But we have to take a patient approach and know that a system can create wealth in a pretty short amount of time, guys, relative to wealth building. So what do we do, Andy? Number one is, in my mind, are we creating a system that will allow us with some time and consistency to really, truly build some wealth? That's a question. Are you building a system? What does your system include, right? So I can only tell you guys what I'm doing because I'm not a licensed financial advisor. So I can't tell you guys what to do and I can't give you investing advice or anything like that. This is for entertainment purposes only, right? Which I think is clear because I'm down here wearing a Nope shirt and I'm in my dungeon garage. So I hope people clearly wouldn't take financial advice from a guy like this. I'm not wearing my suit and tie or anything like that. But here's a theory, okay? Just think of this, which is just, I'm going to try to give you guys an idea of a system. An idea of a system. So if you put a system in place, you'll choose your own system and choose what you're comfortable investing in, okay, and all that stuff, okay? I don't give investment advice once again, but here's kind of an idea, a theory of a system, and you guys tell me what you think of this system, okay? So perhaps we have something that's called income. Most people do. Even 40 and 50-year-olds still busting butt. So we got something called income. If we can be fair about income is, oh, you know what? And I guess I can do leg extensions while I'm sitting here. At least I can get to working out because I'm really just chatting. I get to chatting too much with you guys. Hold up a sec. I'm gonna have my little cameraman stop moving and stop filming me, if you will. Stop. Okay. Okay. So I figure I can get to working out because I am not doing my exercises. I'm chatting with you guys too much. But back to the system, guys. So here, I'm going to tell you a little bit of a system and see what you guys think of it, or see what you guys think at least of the theory. The theory of a system, like the one I'm going to tell you right now. The theory of a system. Okay. So here's a theory. Well, here, let me just start with a couple questions. Let me ask you this. What do you guys think? What do you think? Question. Because I know the answer. But what do you think would have happened if we all, everybody on this call right now, what if we all would have put $100 per week? And I say $100 per week because I'm saying I think people at all ages, probably most ages, could afford $100 a week if they really focused on it. Because we spend $100 a week on going out, drinking beer, you know, all sorts of stupid stuff, getting Starbucks every morning. It's like, dude, you can spend $100 a week on dumb stuff. So what if we took $100 per week? I'm just saying this theory here. One little simple thing. What if you took $100 per week since 2015? Since 2015, you would have just put $100 a week into Bitcoin. If you would have put $100 investment per week into Bitcoin starting in 2015, and you never cared about where the price of Bitcoin went or anything like that, you just knew that you were transmuting United States fiat currency that you get paid in. You were transmuting fiat currency that you get paid in. And if you guys know, fiat currency's dead. It's lost all of its spending power, and they're about to blow it up here in the next 3 years, worse than ever, with the printing machine and that. So the United States dollar's dead. There has to be a transition, right? So just think of that. If you were to put $100 a week of fiat currency into Bitcoin and just steadily put $100 a week into it since 2015, do you know how much that money would be worth now? And you guys, AJ just said this is gold. Well, what about gold? Let's not talk about Bitcoin. Bitcoin's become digital gold now. It's easier to move around. You can trade it country to country. It's digital. You can move it, and that can't really do that with physical gold. That's why physical gold has always been tough. Andy Woodward, 52,900 approximately putting that in. And I don't even know how you would calculate all that growth, Andy, because dollar cost averaging along the way, you'd have been buying some Bitcoin at $5,000. You'd have been buying some Bitcoin at $10,000. You'd have been buying some Bitcoin at 15, and so on and so on. So, and it would have gone up like crazy and down like crazy on the way, hasn't it? It's been very volatile. But that's just a thought process to understand that we all could have been doing that. We all could have been putting $100 a week into Bitcoin. Most of us didn't, and most of us missed the whole big giant growth that Bitcoin has had over the past 10 or 15 years. But think of this as a systematic approach. Are we taking our income, which is paid to us in fiat currency, which is another man's debt in this banking system? So we're getting paid with debt. The money's not even real. They took it off the gold standard. So when they took the United States currency off the gold standard, which if you open your wallet and pull a goddamn dollar bill out of there, or $20 bill or $100 bill, it says Federal Reserve note right on it. You guys know I'm in the note business. So when you look at what it is, a Federal Reserve note, a note, or short for promissory note, okay? When it says Federal Reserve note on there, the piece of paper you have is a promissory note. It's not obviously anything of value. It's a piece of paper with ink printed on it and a number, like Monopoly money. I got the Monopoly game in here for my kids. I'll show you. It's no different. So are we actually taking at least a systematic approach to begin with to perhaps understand that we need to start transmuting fiat currency that we get paid in into something else? an asset of value. And I was just saying Bitcoin because you get the point. Bitcoin's outperformed every asset in every asset class over the last 10 or 15 years, period. But even just think of regular gold, right? Regular gold, God's money, and silver, right? Didn't they have a big run? Haven't they done well? But the point of the matter is, as a fiat currency gets destroyed and dwindles in its spending power and its capabilities, that fiat currency is dwindling to its death. So we just don't save that. Okay, let's just say, what would have happened if you would have put $100 a week into a savings account? Because our parents and grandparents told us the most wise investing strategy ever, which was save it for a rainy day. Save your money for a rainy day. You remember that? Whatever that meant. Why would you spend the money on a rainy day? That never made sense to me. Anyway, save your money for a rainy day. You guys can tell me where that old statement came from. But if you saved your money for a rainy day, let's talk about the difference there with this one step. And then I'm going to go into the systematic approach. Okay, guys, so that you can understand how this can be done in the next 5 or 10 years. In the next 5 or 10 years, we can all build wealth with a systematic approach. Period. You have to be stoic about it, though, and you can't be emotional about it. It's one of the things that does not build wealth is reacting on emotion. Matter of fact, emotions are how we get liquidated and how the rich keep getting richer, because we usually in markets are the wealthy people's exit liquidity. They know how to play the market emotions on us retail investors. So anyways, I digress. Let me get off my soapbox. If we put $100 per week into a savings account, Andy, do the math for me, brother, if you can. I know maybe you got a calculator. Andy, do the math for me, because I don't know the numbers. Let's say 10 years. 10 years. So what? 10 years is 120 months, right? So what's 120 times 100? 1,000. So you guys see what I'm saying is if you would have put just fiat currency into a savings account, because we're saving for a rainy day and we're saving up money to maybe go make a move eventually when we save up enough, right? We're saving fiat currency. Over the last 10 years, if you put $100 a week into a savings account, okay, how much money would be in that savings account today? If you put $100 per week for 10 years into a savings account, how much money would be in there? I'm going to prove to you guys an interesting point here. So just let me know how much. You put $100 a week, and guys, I am doing some light leg exercises while I'm talking to you here today, but we knew this would be a lazy day. Nope, we don't skip leg day, but I also don't go crazy and get all out of breath and sweaty with my legs because I got a bad knee. So if you put $100 a week, somebody give me the answer. It's easy math. You probably don't need a calculator for this one. Well, AJ, then that would be wrong because Andy Woodward said there would be 52,900 approximately putting in. So about 70K. Okay, so let me just go with this, guys. So we're, for lack of proper math, 52,000. And that's why you were already saying 52,900. Okay, cool. So check this out, guys. If you put... Well, first, if you started putting $100, you put $100 into Bitcoin when Bitcoin was $6,000 per coin, and Bitcoin went from $6,000 per coin now to wherever it's at, 80,000, and it did go up and down. But if you put the $100 into Bitcoin when Bitcoin was $6,000 a coin, and Bitcoin went from $6,000 a coin to $80,000 a coin, how much did that $100 bill grow to? That's about a 6x, 7x. So your $100 bill grew to 700. By sitting there in Bitcoin. Okay. Now let's talk about what happened to your money. Would be a multimillionaire? You could be. If we did the dollar cost averaging and we tried to figure it out of putting $100 a week into Bitcoin since say 2015 or so, for like the last 10 years, we would need to do the math. That's a tough math to do, but you certainly would have a shitload of money. Okay. Now, on the other end of that, we decided not to transmute our fiat currency, which is failing, into something that has future potential and will still be around, because the fiat currency is failing. It's losing its spin. And when I say failing, guys, you realize the fiat currency is losing its buying power. So since 1930 till now, thanks, AJ. Since from 1930 till now, the United States dollar, the fiat currency, the monopoly money, has lost 97%, almost 98% of its spending power. Okay? Because you realize a dollar is still a dollar. The dollar bill doesn't change in value. The dollar is still a dollar, but the dollar buys less stuff in the marketplace, right? Houses have got more expensive. Cars have got more expensive. Inflation. So it eats away at the value of your currency. So what's interesting is this. Think of it this way too. If you would have put the $100 a week into a savings account to save for a rainy day, and you didn't transmute it into something different than fiat currency, what you've done is you've saved paper monopoly money, normally in a bank, and the banks don't have your money sitting in the vault. The banks are loaning out your money 9 times over. They have fractional reserve banking. So if we put money in the bank, they're able to loan out 9 times what you put in there. It's a scam, guys. I hope you understand that the United States currency game is, devaluing assets. The United States currency, guys, is toast. So, like, just here's another point, though, right? Like, I'll get off my soapbox. I get going down these rabbit trails. I apologize. If you put $100 a week into a savings account at the bank, forgetting all the other BS, you've, as Andy said, you've put in there $52,000. Over time, you've put in there $52,000. But over the last 10 years, as you've been saving that money in fiat currency form, over the last 10 years, how much less spending power in the marketplace does that $52,000 have? 10 years ago, $52,000 would have bought you a lot of stuff, or at least a lot more than what it would today. So the same 52,000, see, the dollar amount hasn't changed denomination. The $100 you put in the savings is saved at $100. So when you go back and look at your savings account later on in the future, you go, see, I'm smart. I haven't lost no money. I didn't risk nothing. I didn't lose no money. I got my money saved. The problem is inflation is invisible theft of your money, invisible erosion of your money. So the illusion is we see the bank account, we see the balance in the bank account. It keeps us happy because, let's say we got 50 grand in there. And next week when we wake up, we can look at it and go, there's still 50 grand there. Being smart, saving my money, not being risky. But you don't know how risky you're being when you're saving fiat currency. So one of the things I would try to think of doing, you guys, and I'm talking about gold and silver, and I'm talking about perhaps some stock market plays. I'm talking about some crypto plays. Bitcoin, we obviously discussed as one, just for an idea. But the theory is, if along the way you have a systematic approach over 5 or 10 years to be stoic and intentional about not saving money, but trying to transform fiat currency into something else that's not being smashed, not being eroded, not losing its power, but in fact growing in demand and growing in value. And try to transmute fiat currency into something different, okay? That'll grow in value over time, not deplete in value over time. Does that one make sense right there as far as a step 1 thought process in a systematic approach to building wealth? Don't sit on fiat currency. We're getting paid in another man's debt. There's no real money in the system. It's fake. It's not backed by anything. And it's literal monopoly money. So let's not save that. Because as we sit on it and we save the fiat currency, it continuously, day by day, as time goes on, loses its spending power. And therefore, it's devaluing. Okay? So that's one thing. Are we systematically and stoically taking some of our fiat currency? And in fact, if you looked at wealthy people have the mindset of when you get fiat currency, you invest it first, and then you spend what's left, if any. Obviously, most people in the public are taught the other way as a consumerism society, which is when we get some money, we spend it on all the stuff we need to spend it on first and invest the rest if there's anything left. Most people don't ever let themselves have something left at the end of all their spending habits. Therefore, people aren't investing. You see what I'm saying? So it's just a different mindset. But are we taking some fiat currency and, yes, own assets, not monopoly money, Chase? Shit. The monopoly money can buy you an asset. An asset is real. An asset exists, right? Money, fiat currency, can buy you a rental property. Well, a rental property is standing there. It's a place. It's a roof over someone's head. It's a place for somebody to live, and people need a place to live. So you'd rather have an asset that produces cash flow rather than just have to trade your time and energy in a job or personal effort and energy to get fiat income as pay. Okay, so are we taking that and transforming it? That's number one. Okay, so we know, like Chase said here in the chat, we know that if we were to put that $100 a week into something like Bitcoin from 2015 to now, Chase said it right. Depending on, I mean, we'd have to do all the math, right? I wouldn't get it, but you might have $1 million. You might have $1 million instead of that $52,000 saved, in which is now not even worth the 52,000. It's worth less because, and that's an interesting term, right? Worthless. So worth less. So fiat currency, as time goes on here, fiat currency becomes worthless. It's worthless. Get it? So anyways, that's number one. You might have $1 million worth of Bitcoin right now if you put $100 per week into Bitcoin from 2015 till now, and you would have just religiously kept doing that. Transmuting $100 per week from fiat paper fake money into something like Bitcoin or gold or silver or something like that, okay, guys? Doesn't have to be Bitcoin, whatever you like to invest in, but I'm just giving you guys an example, okay? Now, this is where the stoicism and the patience comes into play. What do we do when we see unrealistic returns? When I say unrealistic returns, guys, when we are comparing things to what they usually use as the index, which is the S&P 500, okay? So we use the S&P 500 as an index, and if the S&P 500 is notorious for earning about an average of 9% per year, the S&P 500, 9% per year. Gosh, my legs are getting warmed up now. When we get unrealistic returns, who can tell me if you agree or disagree? Do you agree that people that have been in Bitcoin for the past 10 years have had what we would consider to be unrealistic returns? Can we say that people that were bought into silver and gold have recently, in the past, say, 5 years, have seen what we may think of as unrealistic returns, which is really great, right? But what do we do then? So we've had our fiat currency that's been transforming or transmuting into something different that's an asset that's going to increase in value. When this asset does, because guys, by the way, we're not going to stop putting the $100 a week from our income into assets. We're just going to have that as a habit. And maybe you guys could put $200 a week, $300 a week, $500 a week. I don't know what your income level is or what your financial situation is. But the point of the matter is, are we investing money every week, all the time, and transmuting fiat currency into something that's asset-based and that'll produce some sort of return, growth, net worth increase, or what I like, which is passive cash flow, okay? Not income. Income and cash flow are two different things. Income's from working and trading your time and energy for fiat currency. Cash flow is having an asset that pays you more fiat currency without you working for it. That's the difference between income and cash flow. So there's kind of my next move, or something that I would maybe suggest might be a okay part of the system, which is if you're transmuting your fiat currency, what do we do when we see unrealistic returns? Which hopefully you will see if you're doing some smart investing and you're following some economic trends and things like that, right? Bitcoin's not going nowhere, guys. Bitcoin ain't going nowhere. It's down now, but it'll be up again. It'll hit all new time highs. You know, soon enough, Bitcoin will be $150,000 per coin. And then soon enough, Bitcoin will be $200,000 per Bitcoin. And you get it, guys. It ain't going nowhere. And there's other cryptocurrencies you could talk about in this aspect. But I'm not just saying cryptocurrency. Whatever you like to invest in, but is it a hard asset, and is it something that'll grow and be around? So now, we see unrealistic returns. What's up, NJ? It's leg day, so I'm paying more attention to you guys than I am my workout. Kind of on purpose, probably. But nope, we're not skipping leg day. We're still going to do it even though we don't like it. Okay, so we're talking about fiat currency, transmute, gets into something like a Bitcoin or a gold or a silver or who knows, whatever you like to invest in. But it's something that you have conviction about, you've studied, you believe in, and you think that over the next 10 years, it's going to have a major growth. Major growth. It could be stocks, cryptos, gold, silver, whatever it is. But you're taking fiat paper money, which is monopoly money. It's fake. It's printed paper. It's not backed by a damn thing, and it's losing all of its spending power because they're printing more and more of it like crazy. Step one. Step two, we see unrealistic returns. And you don't know when it's going to hit during those 10 years, but you're putting your money over there. And so your money's sitting over there. And when that asset pops, if it's gold or silver, like has happened recently, if it's Bitcoin that's outperformed every asset class in the last 10 years, here we go. We've got, excuse me, sorry, frog in my throat this morning. We've got to pull profits. Okay, got it. Leg day. All right, NJ, awesome. I need to start working my glutes out. I got to get on this pulley machine and do something. I've been told I ain't got no butt. I got cardboard box butt, they call it in my family. A flatty patty. No pun intended. But good to see you're here. I'm doing some legs too, light as I talk. And it's just getting the body moving still. It doesn't matter. So anyway, back to my point. We pull profits is what we do. We don't just watch something go up and see majorly unrealistic returns that don't normally happen in normal markets and go, damn, I all of a sudden just tripled my money. That's, to make 3x on an investment or something like that is not normal, right? When we're looking at the S&P 500, it's about an average of 9% return per year. So if you go like, damn, I doubled my money this year. It really popped off. Well, we got to be stoic about saying, look, we're going to pull profits out of there. Reason being, because as things go up, things go down. As things go down, things go up. So the beauty of something like the cryptocurrency markets right now, in my mind, the beauty of it and the danger of it is the volatility. But the beauty of it, it's the volatility, okay, if you know what I'm saying. So let's actually pull profit, okay? When we pull profit, we now have cash flow. It wasn't income that we had to trade our time and energy for. It was cash flow that we were able to pull as profit from a very profitable investment that we were stoically putting money into week after week after week with no expectation. But I'm promising you, when you're in the game and things do pop off, which is when, they do several times in a 10-year cycle, you can pull profit. Now, what do we do with that money? What do we do with that money? In my opinion, again, just my opinion, guys. In my opinion, I want to create, don't know what your plan is. I want to create stability for my family because I have kids, stuff like that. So my family is important to me. If I were single, it would be a little different, but I'm not single. I have a family, I have kids, wife, and I care about their future as much as I care about my little life while I'm here. And as a matter of fact, I start to care about their future more than I give a crap about mine. So you know how that goes. Your priorities change. So what I would be doing, guys, is I would be de-risking that capital that was unrealistic return anyways. And I would de-risk that and protect it. That would be my first step. Okay. And the way I do that, guys, is we have a dynasty trust for our family. It's called a dynasty trust. And the reason it's called a dynasty trust is it's a trust that lasts multiple generations. Okay. It is a revocable trust while you're alive and in charge of it, and it becomes an irrevocable trust once you pass. Meaning once you pass, the rules that were set in place underneath that trust have to be followed then on, and our trust lasts 365 years. Multiple generations, okay? And what I do is I pull that profit out of there, and I would fund cash value life insurance policies on me, myself, my wife, and my family members with that money. And I would fully fund cash value whole life insurance policies that are owned by the Dynasty Trust. That's what I would do first because it creates protection and leverage. So we're protecting our capital now. We're protecting the capital that we've made, protecting it so that we won't ever lose it. That's huge, right? So when I do that, I put into those cash value life insurance policies. Now, why is that? Okay, so check this out. The cash value life insurance policies grow at about 4 to 6% per year in perpetuity with compounding. And I like that word perpetuity. It just means forever with no break in it. So when I put the money, let's say I pull $50,000 profit, which were unrealistic profits because I was stoically dollar cost averaging, they call it, or just putting $100 a week into something like Bitcoin, or putting $100 a week instead of Starbucks coffee. Cancel your Netflix membership. You don't need that trash anyways. But, we spend enough money to where we could figure out a way to invest $100 a week. We started there. We put it into something like Bitcoin, gold, silver. Boom, it pops off. At some point, we don't know when, but it pops off and we get unrealistic returns. 50%, 100%. We double, we triple our money in a short amount of time. Whoa, hoo-hoo. Well, don't just let it sit there because it'll come back down and it'll be fictitious money like you never had it. So what we do is pull the profits. Pull the profits. Take the profits. I like to put it into a dynasty trust that owns whole life insurance policies that are cash value. Why? The money you put in there grows at 4 to 6% per year and compounding with perpetuity forever. And you know the power of compounding. And if you don't, you should study compounding. Okay. But 4 to 6% per year returns on that money forever with no break. Okay. Also, they're cash value life insurance policies that I've funded. So each of these policies or each of these little bank accounts, glorified savings accounts, I would like to say, to make it easy to understand, is they all come with death benefit. And we're all going to perish at some point, period, end of story. You ain't getting out of that one. And so if you have these policies, glorified savings accounts and cash value life insurance that are funded, the money you've put over there is in an insurance company. If you guys don't understand, insurance companies have been around longer than the American banking system. So we're talking about the Great Recession, the Great Depression, the mortgage meltdown of '08, all these disasters, COVID and all this stuff. The insurance companies have outlasted all of it. So you're insuring your money, and we insure our car, and we insure our artwork, and we insure our Rolex watch, and we have insurance on our house, and we have insurance up the ass, but we don't insure our money. It's kind of goofy. So let's insure our money. It's insured now. It can't be stolen from you. It can't be lost. It's not subject to volatility of markets, and it's in a position in which has outlasted even the American banking system and been around longer than that. So look up the Rockefeller waterfall effect. If you look up the Rockefeller waterfall effect, you'll see that this is one of the reasons why the rich ensure that they keep getting richer. So we've heard, the rich keep getting richer. This is one of the reasons right here. And you know that you can do it so that your family keeps getting richer, and you can be the person to put that in place. So cool stuff, right? So I'm going to fund these life insurance policies that are cash value and leverageable. The money that goes in there grows at 4 to 6% per year in perpetuity. All the accounts that I've funded come with death benefit. We're all going to die at some point. And all these policies are owned by the Dynasty Trust. The Dynasty Trust is the beneficiary of the death benefit. Does it make sense? Now, why would I do that? You already heard the couple different reasons that are pretty intelligent, right? You're insuring your money, you're protecting your principal, you're keeping your money in place safely where you can sleep at night. It's growing at 4 to 6% per year return with compounding with no break. Okay? These are already cool things. Third cool thing, it comes with death benefit, and we're all going to pass at some point, and that death benefit is going to be an influx of capital that is now going back into the family dynasty trust. This is huge, right? But the cash leverageability, the cash value life insurance is the cool part, okay? So cash leverageability or cash value life insurance means that when you pay into these accounts, you're going to build up or be purchasing a certain amount of death benefit. Death benefit that happens to be paid later when one dies, right? Or one passes. So you have this accumulated death benefit, which is obviously the death benefit is much higher than the money you've put in. Well, interestingly enough, with the cash value life insurance or cash leverageable life insurance policy is that they allow you guys to borrow, they allow us to borrow. And you know, this is Richie Rich level. I'm telling you what's crazy is it's really not. I mean, of course you could say that because yes, the Richie Rich people use these formulas and they use these systems. We just haven't been taught them because they don't teach them in school. Our grandparents and parents weren't taught these things. It's just something that is not taught. That's all. We have to seek to find, and we learn, and we say, holy cow. And the only problem we can fault people of in this kind of thing, guys, is once you know about it, but you don't act on it, then we can blame ourselves. If we don't know about it, well, you don't know what you don't know. It's all good. I didn't know there was a thing called a dynasty trust, but I found out, okay? So anyways, cash leverageable, right? You can borrow money from the insurance company. You can borrow money from the insurance company against your future death benefit. That's why the money you put into the policies stays there, growing at 4 to 6% per year. When I want money back out of the insurance policy, I'm not actually taking a withdrawal of the deposited capital I put into the policies. No, the deposited capital that I've put into the policies have purchased me a certain amount of future death benefit. And so the amount of that future death benefit paid later when I die is what I get to borrow against Okay, so the bottom line is if I put $50,000 total if I put $50,000 into these cash value life insurance policies, I may be able to very easily and very quickly borrow back out 45 grand of it. So, and not 45 grand of the money you put in. It's 45 grand you're borrowing against the future death benefit that you've built up by funding those accounts. If that makes sense, okay, guys? So it's just an interesting thought process to know that your $50,000 is still sitting over there, protected and growing at 4 to 6% per year. I've borrowed 45,000 out real quickly against my future death benefit. So I put in 50,000 and I was able to get back 45,000. But the 50,000 still remains over there growing at 4 to 6% per year, and I've borrowed against death benefit. So now what would I do with that money? See what I'm saying? What would I do with that money? This is a system, guys. What would I do with the money that I borrowed out of my insurance policies against my death benefit? Now I've got 45 grand back in my pocket. Even though my family is set up, the trust is set up, my kids are going to be fine when I die. Death benefit's going to go into the family trust or the dynasty trust. The dynasty trust, pretty much operates the family's wealth. And so the family is going to continue getting richer over time. When you pass, when your wife passes, when anybody passes in the family that you've funded one of these accounts on, death benefit comes into the dynasty trust and continues to perpetuate and grow the family's wealth generation after generation. So smart thing would be if you could over time have a policy like this on every damn insurable interest in your life. Right now, our dynasty trust has 23 policies in it. This is 23 family members that we've funded money into one of these policies on. And so the whole family's covered into the dynasty trust. So this is a family bank you're creating and a family perpetual wealth growing machine for generations to come. So that means all of a sudden, just by doing that step, you became the change maker in your family's financial future and family and your family tree. You're the change maker financially for the rest of the generations of your family, which is pretty cool. Okay, because now, with that in place, you can rest assured that when you're long gone off the planet, you've done the right things where your family's taken care of. So that's why I do that first. But you can borrow against the money and you can get it back out in your hand. That's what I'm saying. So I put 50 grand in the policies. Now I borrowed out 45,000. I've only gone out expense-wise $5,000 of my own money to set all this up. Now, if I was able to borrow out that money, like I'm telling you can, what would I use that money to go do? Well, here's what I do. Here's what I do. I buy cash flow with that money. I buy cash flow. Now, you guys know that I specialize in buying discounted mortgage notes across the United States. The reason why I like that as an investment vehicle, in fact, of 25 years, 30 years of entrepreneurial endeavors and being in sales and investing and all that my whole life practically, I really haven't seen much of a better investment vehicle, my opinion. So that's why I like to take that money and buy cash flow, contractual cash flow, not volatile cash flow, not up and down cash flow, not cash flow that I have to be looking at and timing the markets. Nope. Pure contractual cash flow. So in a mortgage note situation, now I take the $45,000 that I borrowed out of my policy. I take that $45,000 and I go buy a first lien mortgage note that say has 20 years of payments left on it. Now what I've done is I've created a stream of reliable and contractual cash flow. And remember, cash flow is incoming dollar bills that is produced by assets that you don't have to work and trade time and energy for the money, but the money still comes in. It's called passive cash flow, okay? So I would go buy a mortgage note with that $45,000. Why is that? If I buy a mortgage note in first lien position at $45,000, that's my purchase price. Well, we buy these notes at a discount. And so they probably owe about 60 grand. So the homeowner or the borrower owes $60,000. I buy the note at a discount for $45,000, and the house that's acting as my collateral is probably worth 100 grand. So if the house is worth 100 grand, the people living in the house owe 60,000, and I'm able to buy the note for 45,000. Here's what's happening. I'm taking over the mortgage payments with that property as my collateral. So now am I in a good protected collateralized position again with my money? Not being stupid. Highly likely I'm not going to lose a dime of it. It's only going to grow. How will it grow? We don't know. But I buy a discounted note. Now in this scenario, let's say this note I bought, it pays $500 per month mortgage payment. So now I have $500 per month of passive cash flow that's coming in now to my life. So you guys realize I've only pulled some profits out. So you still have all the money that you're still continuously weekly contributing to in your gold, your silver, your Bitcoin, or whatever asset it is that you have conviction will be around 10 years from now, will grow, will be maybe a part of the new banking system, a part of the new financial infrastructure, whatever it may be. Study and look and find companies or find valuable products that you can invest in and something that may have the potential to get unrealistic returns. We pull the profit from those unrealistic returns when we see them. We pull the profit. We're stoic about taking some of the money when we have some. And we pull the profit. We fund cash value life insurance owned by a dynasty trust for your family. And we fund those cash value life insurance policies because it protects your money. It grows in perpetuity with compounding. And it all comes with death benefits. So each member of your family that ends up perishing is only going to add more and more money to your family. So it's a really brilliant system. Look up the Rockefeller waterfall effect. What would the Rockefellers do? It's a good book. So then we're able to borrow against the cash value of the life insurance death benefit. And usually you can borrow out just about as much money as you've put in. It takes a little bit of time, a year or 2 or 3 sometimes, to accumulate this ability. But again, this is a patience game and a really build wealth over 10 years and secure your family's wealth over 10 years' time. It's kind of a program that I'm going over in a system that you got to follow. All right, so now you take that cash borrowed against your life insurance policy, you go buy something like, I just like a mortgage note because it's secured, it's collateralized, it has potential upside, and it spits off monthly cash flow that's contractual, not volatile. So let's say that mortgage note that I bought for $45,000 is paying, let's call it $600 a month. So now I'm collecting a mortgage payment every month, passive cash flow. Someone's paying their mortgage payment. I'm collecting $600 a month. Passive cash flow. $600 a month passive cash flow. Let me ask you a question. What do you think? Yes, AJ, we buy cash flow. Okay? So what do we think? Just your guess. Just your guess. What do you think now we start doing with the $600 per month that's coming in from the mortgage note? Any guesses? What do we start doing with the $600 a month now, passive cash flow that keeps hitting our bank account every month on the 3rd because someone keeps paying their mortgage payment every month? Oh, yes, that's right, AJ. We reinvest it. Good call. Now, if we're following a systematic approach, the cash flow being paid every month by the mortgage note is you're being paid in what? Yes, you could reinvest or use it for bills. Absolutely. Now, when we're talking about being 40 or 50 years old, which is where this all started, we're talking about being 40 or 50 years old and you're being behind on your retirement goals. You're not feeling comfortable with the wealth you're building and all that good stuff. Your IRA is not going to do it for you. Your 401k is not going to do it for you. So we're talking about that age of 40 or 50, right? And being able to take in a 10-year time frame and build real wealth in a systematic approach, not a guess. Mathematical, systematic approach, we can build wealth. Okay. So in my guesstimation, if you're 40 or 50 years old, you still have the energy to work. So you're still working. You're still trading your time and energy for money all this time, guys, while building this financial system for yourself and your family. But so if you have the energy and you're not old yet and you're not injured in that and you're still creating income. Yes, Bethany, we just covered that. We just covered that if you're coming in late. I'm telling the whole system, right? And a part of that was buying a mortgage note. But now we have the mortgage note that's producing this $600 a month. As was said down here in the chat somewhere, as was said, yeah, you can reinvest it or use it for bills. What I'm saying here in a systematic approach to build real wealth over 10 years is that I'm hoping that you don't increase your lifestyle yet. I'm hoping that you don't say, ooh, I've got this $600 a month of passive cash flow coming in now. I can finally afford that, brand new ZR1 Corvette I've always been looking at. Or, man, I really need those Louis Vuitton bags I've always been wanting, that luggage set and all that crap, right? So I'm hoping that you don't think of this as spendable capital, at least in your mind. Is it? Yes. Is it? Yes. And we can talk about later after this wealth plan is built. Okay, and we follow it stoically for 5 or 10 years, then it's at the 10-year marker when it gets nice and fat, when you can now use your cash flow and your wealth to go out and buy nice things like a Rolls Royce car, whatever it is you want to have. But I'm saying it's too early now if we're only 40 or 50 years old and we're trying to build some wealth and some reliability and for our retirement. So Yes, real millionaires live below their means. Absolutely. So here we have this $600 a month coming in. Hopefully you're still working. Hopefully you're still paying your bills with your active income and you don't need that $600 a month. And you're stoic enough and mature enough not to say, ooh, I'm just going to increase the hell out of my lifestyle now. Because that's another problem with people in America with building wealth. It's every time we get a little bit more money, we increase our lifestyle. Every time we get a little bit more money, increase our lifestyle. So people are broke at 100 grand a year. People are making 200 grand a year, still broke. People are making 300 grand a year, still broke. They're living paycheck to paycheck because every time their income increases or their wealth increases, they increase their lifestyle. Okay. So we don't want to do that. So we're being smart here about building real wealth and real reliability for retirement and setting our family up and doing all that, which should be more important to us than right now, immediate gratification of having whatever it is car you want or whatever. Okay. So we've got $600 a month coming in now from the note. I said, what do you think I'd do with that? Jamal said, well, you invest it or you can spend it. I recommend investing it, right? Because we're on this 10-year plan to build wealth, systematic approach, stoic manner, knowing it's going to happen, not a guess, not a get rich quick scheme. This is a 10-year plan, I'm telling you guys, right? And I would say give yourself 5 or 10 years to really build it. Now, if somebody's really old at 73, 80 years old or whatever like that, can they begin this process? Maybe not see the fruit of it in their lifetime, but can they begin the process and set their family up, their kids and grandkids for this process? Absolutely, right? So it's never too late to start. But this conversation started with a 40 or 50-year-old man. Not there quite yet on their, or 40 or 50-year-old woman, sorry, Bethany and AJ, or excuse me, Bethany and NJ. If you're a man or a woman, you're 40 or 50 years old and you're thinking, God, whatever I've been doing in my life has not created any type of retirement stability. And I might be looking a little fearful of the age 65 coming up quick and me not being prepared for that. So that's where we started all this. Okay. So now we have the $600 a month coming in from the mortgage note. What do you think I would do with that? I know that AJ knows what I would do with it. Are we going to completely come back around full circle now? Okay, because remember, this all began by us just taking a little bit of our income, right? Because we're all working, we're all making income, we're all paying our bills, we're all having enough money to go to Starbucks all the time and spend $6, $7, $8, $10 on a coffee. So I mean, let's think of all that. And it all started with, let's put $100 a week, $100 a week, $100 a week, stoically $100 a week into something other than fiat currency. Don't save monopoly paper. Put it into something that's worth something. So I was talking about Bitcoin just because we can all do some mathematics and say Bitcoin's been growing more than any other asset. So if you had to put $100 a week into Bitcoin from 2015 to now, you might have $1 million. Would have been smart, instead of saving money in the bank, right? All right. So we have $600 a month coming in now. And do you think that if I don't need that money to live off of, and if I'm not trying to increase my lifestyle or be fancy with that money, that I would have that systematic approach now start to work faster on my behalf? So now I can take the $600 a month that's coming in from the note, and I can put that $600 a month into what? More assets, right? I can be investing now at a much larger scale. I'm putting the $100 a week I'm still going to be putting the $100 a week from my active income. But now I have another $600 per month coming in that I can also put over there into those investments that I think are going to be around the next 10 or 20 years. I think it might be the new part of the banking infrastructure. It might be, who knows what, do your studies, invest in what you're comfortable with. But, gosh, guys, if we would have invested in Amazon stock 10 years ago, would we have done pretty well? If we would have invested in Tesla stock 10 years ago, would you have done well? If you had invested in Facebook, Walmart's. Okay, so I'm just saying, guys, there's all these options. You just have to be smart about it, okay? In companies you think are going to have intrinsic value to the marketplace and be around 10 or 20 years from now. So now, the scenario you're explaining yields at 12%. I might even yield more than that. But depends on the note you buy. But bottom line is this, guys, you have that $600 a month now that you're transmuting that $600 a month of passive cash flow fiat currency into more assets that produce growth, net worth, and leverageability. When those assets continue to rise, because over 10 years, it does this over 10 years, but normally it does this over 10 years, right? As we've seen Bitcoin and other things do. So if you're patient, there's going to be some ups and downs. There's going to be some volatility in the markets. But of course, you're going to find another spot like when Trump got elected this time, or, there's these circumstances that happen that all of a sudden there's unrealistic returns that happen. All of a sudden things double in value. All of a sudden there's a huge run again. And what are you doing? You're making sure that you stoically pull those profits out of there when you have unrealistic returns. And what do we do with the profits? We fund more life insurance policies, protecting our capital, growing at 4 to 6% in perpetuity, and it's cash leverageable. Then guess what? We borrow against the cash value of the life insurance, and we buy things that produce cash flow, and then we take the cash flow and we put it in more assets. Do you guys understand? I'm just trying to show you. I'm trying to simplify this. A one-on-one coaching call with me, or with people that meet with me on Thursdays on the mastermind call in my community for an hour and a half every Thursday. We get to talk about this stuff in great detail and in great structure. This was just kind of an overview to just simply, hopefully, put it in your minds that there is a systematic approach to it. So, Andy, if you're 40 years old or you're 50 years old, if you're 40 years old or you're 50 years old, you can start to stoically and maturely create yourself a financial system in which, in a 5 or 10 year time period, depending on the winds, depending on the market, and depending on some certain things, of course, but I guarantee that if you're transmuting fiat currency, which is losing all of its spending power and is literally monopoly money, like from the Monopoly game I got in the closet in there, is what our fiat currency really is. So if we're taking the fiat currency and understanding that saving it would be stupid, it's becoming worthless every single year that goes by now. In the next 3 years, they're going to lower interest rates next to nothing again. They're going to open up the liquidity markets, and they're going to print the shit out of the United States currency like nuts. And if you see that most governments, like the United States government, is doing what they have an advantage to do unfairly in the Ponzi scheme that United States fiat currency really is. What if you had the ability right now to print billions of dollars, and then take the billions of dollars you've printed and then transmute those into Bitcoin and other things? What if you had the opportunity to do that? That would be illegal, wouldn't it? Well, that's what they're going to do. How do you have this info and not famous? Oh, that's nice of you. Not famous. Well, I don't put myself out on social media much, guys. If you look at my social media channels, I'm not really heavy into it. I'm one of those guys, I really like to be present in the moment. I'm not one of those guys that likes to be in every place I'm at with my family and kids and all this and like showcasing my life. Look at me. I'm not that guy. Unfortunately, I wish I was more of that guy. I'd probably reach more people and help more people if I was that guy, but I don't know. I'm starting to do a little bit more of social media this year, as you can see, because I'm on YouTube Live, but I appreciate that comment. That's nice. How many pull-ups can I do? Right now with my torn shoulder, not many. But these days at 46 years old, I'm not in my prime anymore, but I can probably whip out about 10 pull-ups right now. Not a bunch. I'm a little overweight. I'm trying to lose some weight this year again, get my 6-pack abs to show up a little bit more. I got some work to do. And that's why I do this, guys. Body moving, exercising, and hey, why don't we talk some financial intelligence while we're at it? Get ourselves in good physical shape, get our pocketbooks in good physical shape, and set up our families to have a life financially that most of us didn't grow up with, right? We were all taught to save for a rainy day. Well, it wasn't that bad advice. But our parents and our grandparents didn't know that they were giving us bad advice. They only knew what they knew, and they were trying to do our best to protect us. They told us what they thought was smart, which was save for a rainy day. But how'd that work out, right? See, our grandparents were buying houses in San Diego, California for $8,500. That same house. Oh, there's my pretty wife. Hi. Like grandparents were buying a house in San Diego for $8,500. The same house that sold in San Diego 55 years ago for $8,500 is now $1.2 million. I want you guys to think of that so that you guys understand the devaluation of the currency. So you guys get that? So the house has gone up in 65 years. The house has gone up from $8,500 purchase price to $1.3 million here in San Diego. That's the level of increase of the cost of that asset. Does it make sense? So that's why the spending power of the fiat currency or the spending power of the dollar is worth less year after year after year after year. You buy less stuff. Do I play Clash Royale? No. All right, Andy, you got calls to make? Go ahead, crush it, buddy. Have a good day. Make those calls. So You guys get that there is a systematic approach to it, and that if something is followed systematically and stoically over the course of a 5 or a 10-year time period, in perhaps using some of these techniques or some of these systems that I've just explained to you, which is taking fiat currency once again, which is worth less. It's monopoly money, and it's becoming worth less year after year, and they're going to print the shit out of it in the next 3 years. Inflation, hyperinflation happens. Things get really expensive, and the rich keep getting richer because when hyperinflation happens and they lower interest rates down next to nothing, assets increase in value. Assets increase in value. Who owns all the assets? Usually the wealthy people. So yes, it just keeps getting the rich richer, and the middle class separates from the rich even more. And this is going to happen over the next 3 years even more. So let's take cash that we make from our energy, which is called income. Let's take income and let's be stoic about investing as much of it as possible and spending what's left. Not spending as much of it as possible and then investing what's left, because if you spend as much as possible of the money you make, you probably won't have much left to invest with, just the way we operate as human beings. So invest that. I say invest into deflationary assets. We understand the United States dollar is an inflationary asset, designed that way. Fiat currency, paper monopoly money, not backed by a damn thing. And it says right on your dollar, note. So that's not even worth anything. A note is a promise to pay with something of value. So when you take a money out of your wallet and you look on the bill, does it not say Federal Reserve note right on it? So we understand, guys, and now you're understanding, I hope, that it's not worth anything. It is literally monopoly money, just printed paper. We still give it value, and it's still of our means of exchange. But since they have the ability to print or put into circulation as many dollar bills as they please, that means there's an unlimited supply of it. When there's an unlimited supply of something and they keep dumping more and more supply onto the market, what it does is it devalues the existing dollars that are in the marketplace, if that makes sense. This is how this happens, guys. So over the next 3 years, they're going to do it even worse. And we're talking about being 40 or 50 years old and trying to have a plan, a stoic plan to set yourself up better for retirement, to make sure your family is set up better, and to be able to accomplish this task within 5 or 10 years' time. It won't happen in a year. You won't get buff, or you won't lose your beer belly the first couple weeks you start going to the gym. You can't build a real system and build real wealth for your family that quickly either. These are systematic approaches, and having a stoic nature of, like me, wake up every damn morning and turn your camera on and do some workout, even though today I'm not really working out much. Don't tell anybody. Kind of taking a little break day, and I'm doing some legs, if you can tell. Look, I'm lifting the weight up with my legs, I promise. So that's wild, right? So you can take this currency, you can invest in things that are deflationary. The reason I said Bitcoin at the beginning was because I can then kind of help you guys at least understand what deflationary means versus the inflationary nature of our fiat currency, okay? So deflationary, not inflationary. So right now, inflationary currency, printing as much as possible, losing its spending power, and year after year becoming worth less. NJ, check you later. Glad you came in. So, for instance, with a Bitcoin, okay? And guys, I'm not a Bitcoin maxi, and I'm not telling you to go out and invest in Bitcoin. I'm just giving you an example so your brain can understand. Bitcoin itself, there's only 21 million, don't let me misquote, but there's only 21 million Bitcoin that can ever be made. It's called a fixed supply. It's a fixed supply. So if you have something that there's only 21 million of them ever, there can't be any more made. And it becomes a digital form of gold or store of value, like storing your money in gold. The difference is that I can take Bitcoin on a flash drive, or I can take Bitcoin from my cell phone, and I can send Bitcoin real quick to somebody in Africa. That's what the central banking system doesn't like about cryptocurrency, because it's amongst us and we don't have to go through banking systems and things become instant. So can I bring Bitcoin with me on an airplane? Can I bring $500,000 worth of Bitcoin with me on an airplane flight from here to Florida? Could I bring $500,000 worth of real solid gold with me on an airplane to fly to Florida from San Diego? You get it. So anyways, now we have something that has a fixed supply and ever-growing demand. So when we look at those two things, when you have something that has a fixed supply, you can't ever make any more of it. And that's the only problem I have with real gold, guys, is that we can always dig more real gold. We can always dig more real gold out. You can't dig any more Bitcoin. There's only 21 million of them that can ever be in existence, period. So I want you guys to understand that. Not convincing you to invest in Bitcoin. I'm giving you guys a theory. So if there's only 21 million of them that can ever be minted in human history, it becomes a scarce asset. And it is deflationary by its nature. Because if you have something that can't have any more supply created, but yet the demand keeps growing for such asset, and you can't make any more of it, it's a fixed supply, but the demand keeps growing for ownership of it. Then you have something that is now deflationary in nature. It means by supply and demand, it must go up in value. Now, I'm not saying it's not volatile and going to go up and down and up and down and up and down on the way to glory, but I'm just telling you, it's deflationary by nature. That's why I would take inflationary fiat currency and perhaps put it into something that has deflationary nature to it. So you guys understand that? All right, so I'll get off my soapbox, but you guys get it. Take your income, put your income into something that is an asset that's going to grow. Try to pick things that may have a potential in the next couple of years for unrealistic returns. Unrealistic could be double, triple, 10xing your money in something. Now, if we do that, are you just coming to visit me out here all day? I love it. Okay. Wife's got to take my daughter to school. And so anyways, guys, I've kind of been back and forth and ranting and raving, so I apologize for I sometimes go down these tangents. But yeah, no, this was good. I know Andy said, hey, this was good stuff. For me not coming with a subject today. Oftentimes I'll come on here with some sort of subject matter, something that was on my mind, and I'll just start talking about it, and it'll hopefully spawn some questions for people, and hopefully I'm giving some knowledge and some nuggets and that. But today I just was like, I don't feel like coming up with a subject. So when we started early this morning, I was like, guys, I don't have nothing to talk about. So I kind of opened it up, and Andy sparked me with something that was really actually a good question, obviously. That's why I was able to rant and rave on it so much. But if somebody's like 40 years old or 50 years old, and what they've been doing in life as far as their financial systems are concerned has not been accumulating them anything of value to where they can say, you know what, at least I have this outlook of, I'm 40 years old now. Let's say you're 50 years old now. And say I have this outlook of when I am 65 years old, I'm going to have everything all dialed in. Right. But a lot of people, when they reach 40 or 50 years old, are looking at their financial system and what's going on, what they've built. And they're thinking, geez, man, in 15 years, which, 15 years goes by fast. Unfortunately, this life is quick. But you say in 15 years, I don't know what I'm going to do. I don't have any outlook for a good life or retirement. My family won't be set up any more wealthy than anybody else is. We're kind of perpetuating the same things that we were taught by our grandparents. And this old system, guys, this old system is dead. So that you guys know, they're just dragging it along a little longer here. My guesstimation is in about 2030, there's going to be a whole hell of a lot of change that we're going to see, you guys. So the old systems are dead. Saving for a rainy day, putting all your money into a 401k that's diversified across the stock market that you can't even touch until you're 65. And when you start to touch it when you're 65, you start paying taxes on it. Guys, it's a Ponzi scheme. It's a Ponzi scheme. So we want to break out of the Ponzi scheme. So anyways, I hope that's that, guys. And this is just one. Obviously, I don't have enough time to coach people. And this was just sort of a theoretic approach, guys. I'm not telling you to what to go invest in, but hopefully I helped you with a theoretic approach of, do you have a system in place? Do you have a system in place? Do you have an approach in your mind that you're thinking is a systematic approach to building wealth over the next 5 or 10 years? And you know in your mind that if you stick to the systematic approach and you do things slowly and stoically, that it will build to a certain point within 5 to 10 years, you'll be in a much, much different place financially. You'll probably be able to retire way healthier than you were prior to doing these types of systems. And of course, one of the benefits that I now think of more than I did before in my life is I'm not only setting myself up, okay, I'm doing some things and putting some things in place that will literally set my family up even when I'm long gone. So my kids, grandkids, and great-grandkids are going to live a far better life than how I grew up financially because of the things I'm able to put in place. So as we said before, guys, we don't know what we don't know. And that's fair. So when we don't know certain things that we can do, then can we fault ourselves for not doing them? No, because you just don't know what you don't know. But once you start to learn these things, and once you start to understand there is something called a dynasty trust that's not just for rich people, it's for any of us. Well, you can start a dynasty trust through a trust attorney. It'll cost you a little bit of money. Some of this stuff costs a little bit of money, a couple $1,000, whatever it may be, to begin the dynasty trust. But boy, is that going to be a game changer for your whole family tree. So you start this dynasty trust, guys. You start understanding the difference of transmuting inflationary and fiat currency that's becoming worth less day after day, year after year as we go here, and transmuting that into something that is deflationary by nature, that has growth potential, supply and demand issues. I only use Bitcoin as a scenario so you guys get what I'm talking about. Then we would take profits. People who have been investing in Bitcoin, people who have been investing in gold, people who have been investing in silver, people who are investing, I think copper is the next one coming up, copper. But there's these things where they have these hits, right? It's like all of a sudden we've seen big runs on these things where people have seen unrealistic profits to the positive side. So let's pull those unrealistic profits out. And let's take those unrealistic profits that we shouldn't have had anyways. And let's take the unrealistic profits out and secure that money so that we keep it. The way we secure the money is we put it in cash value life insurance. The life insurance companies have been around longer than the American banking system. The life insurance companies have outlasted the Great Recession, the Great Depression, and every other thing you can think of in this economy, period. Every president, every cycle, and they're still there. So you're insuring your money. You're taking that unrealistic profit and you're insuring it, so you'll never lose it. And it'll be there for you, growing at 4 to 6% per year in perpetuity, and comes with death benefit, but you can borrow against that death benefit. That's why it's called a cash value life insurance policy, because they accumulate a certain amount of cash value. So if I put $50,000 into life insurance, but I was able to borrow back out 45,000 of it pretty quickly, didn't really cost me much money to set that up. And now I have that $45,000 still back transmuted into fiat currency, so to speak, because I borrowed against my future death benefit. So I have that 45 grand. I can take that 45 grand, go buy a note that produces $600 a month, contractual returns. And I can take the monthly cash flow now that I'm getting of $600 a month, and I continue to take that cash flow and invest that cash flow more into deflationary assets that have major growth potential. When that money gets unrealistic returns, I pull profits. I fund life insurance. Then you borrow against the life insurance death benefit and you go buy more assets. But you guys just see, I'm trying to give you guys a simplified system. But as you can see, it is a system. It is a system to stoically follow and to have this system in place of that's what you do with your money, the flow of it. That's what you do. And to be quite honest, you can do the math and you can think of if what I'm telling you is bullshit or not. If you would have been doing exactly what I'm saying, and if you would have been doing this over the last 10 years, because I'm telling you guys, for a 40 or 50-year-old, you can be wealthy and you can be financially set and free and also set your whole family up for the future and all that within a 10-year time period. It's where this all started, this conversation. Ask yourself this. If over the past 10 years, you would have done exactly what I'm telling you in this system here, if you would have done this over the last 10 years, it's even hard to do the math on it, guys. I'm just telling you in your mind, you already know. If you would have been investing $100,000 a week, that'd be nice. If you're investing $100 per week into Bitcoin, for an example, if you put $100 a week into Bitcoin over the last 10 years, along the last 10 years, would you have seen instances of really ridiculous, unrealistic returns where your money doubled, tripled, quadrupled, 5x'd? Would you have seen some of that along the way? Yes or no? Answer is yes. So if you would have seen that and just the $100 a week you've been putting into Bitcoin, when all of a sudden, like President Trump got elected, Bitcoin went up to like 120 grand per coin, guys. That's craziness. So when that happened, guys, and you would have seen your Bitcoin just go nutsoid, okay, then you're stoic and you go, well, that's unrealistic. That's unrealistic that I just made 5 times on my money. That doesn't happen normally in normal markets. So let me take that profit, leave the Bitcoin in there, leave some Bitcoin in there. You're in this for the long run. But the unrealistic profit, pull that profit out and secure that money before the markets tank back down, which they do, and all that money disappears as if it were fictitious and never existed. Okay. So you ride the market up. Woo, I'm rich. Ride the market back down. Damn, where'd that go? So no, when the markets go up crazy, unrealistic, you're stoic about pulling profits. I got to get that money out of here and protect it now because it's real now, but it may not be real soon if the market goes back and crashes. So I pull that profit out. And I insure the money. We insure everything else. Why wouldn't you insure your money? So you insure your money and you're doing it in cash value life insurance, in which really doesn't put you out of the money because you can borrow it back out. But the point of the matter is you've not only set yourself up to protect your capital, to have it growing at 4 to 6% per year in perpetuity, also comes with death benefits. So your family's now set up. And it's all owned by a dynasty trust, which the dynasty trust operates the family's wealth now, from now on. So your kids and your grandkids, great-grandkids are all going to benefit from this because of what you set up. So that's beautiful. Now, the cash value portion of it means after that's all set up, I can borrow against my death benefit and get all that money back in my hand and go invest it anyways. It's like a step in between. Okay. So now I'm taking the money that I borrowed from my cash value life insurance and I'm going to go and buy an asset that produces cash flow. So now I have cash flow coming in. Cash flow is money that comes in every single month that you don't have to work for. You're not trading your time and energy for that money. So you're still over here trading time and energy for income. You're still putting your $100 a week over here from your income into that asset. You're still following the same system. Doesn't break. But now you have $600 a month coming in from the asset that's producing the cash flow. So now you're putting the influx of fiat currency, transmuting the fiat currency into more asset, deflationary asset. In this example, maybe Bitcoin. Along the way, then, as those accounts grow, you're going to see along the way in different time markers, you're going to see unrealistic returns where the cryptocurrency market or something blows up. Okay. There's a big announcement, who knows what, and all of a sudden, boom. Well, when it goes boom, you pull profit again. What do you do with the profit? You fund more life insurance policies on more family members and create more and more and more perpetuating family wealth that you can borrow against to go do your investment endeavors. And then we borrow and leverage that capital from the life insurance because it's protected money, but we can borrow against the death benefit. And then we can go out and use that money. We can buy more assets to produce more cash flow, more net worth. So this could be a systematic approach, maybe that just get your mind thinking a little bit of having a financial system in place, which most people don't have. Most people are just willy-nilly and hoping that their individual retirement account or the 401k at the company is going to handle them when they're 65 years old. And we've all seen where this goes. How many times, and I'm not degrading anybody and I'm not being a wise guy here. I'm just telling the truth. How many times have we been into a Home Depot? And you go into a Home Depot and there's a wonderful lady there working or a wonderful man there working at the Home Depot, full-time job at Home Depot. And they're, 79 years old. How many times have we seen it? They make the funny cliche about it and go, oh yeah, well, don't end up being a Walmart door greeter. Well, but that's the truth, isn't it? So this plan that we've all been taught to follow, which is called the 40-40 plan, and the government retirement plan. A 40-40 plan, which is we work for 40 years of our life minimum for 40 hours per week to get by. That's the plan we were all sold. And then the other plan on top of that is, but don't worry, if you're going to waste your whole life working for wages, 40 hours or 40 years of your life, 40 hours a week, don't worry, we got you covered though. Once all that's over and you're old and your energy's all dilapidated and you really can't work anymore, really, and we know that, well, don't worry. We've got these government retirement plans, 401ks, and these kinds of things. And, they'll take care of you when you're older. Pension plan. What is this? Social Security. This says Social Security is done by 2029. I don't know if you guys have been hearing that. So guys, we were kind of maybe sometimes sold the wrong plan. Not our fault for buying into it. It was what everybody else was doing. So it was the norm. It was what our parents, grandparents were doing. But that old plan is dead now. I hope you guys are seeing that the old plan's dead. The fiat currency is being destroyed and devalued. The individual retirement accounts and the 401ks that are handled by some other wealth manager that you don't even know. And they're diversifying your retirement money across the stock market to make it seem safe. But when you diversify money across the stock market, the returns are very poor. So again, it's a trick. It's a Ponzi scheme. If inflation is 8% per year, if inflation is 8% per year, and only going to get worse when they turn this printing machine on full blast. But if inflation is 8% a year and the money in your 401k is only earning 3.5% returns per year, are you winning or losing? Is your retirement account actually growing in value? Or is it
losing value. Well, when you look, the illusion is that it's growing in value. So your IRA money or your 401k money is growing at 3.5% per year. You're getting 3.5% returns per year. So by your vision, you're saying, oh, my IRA is making money. But if inflation is 8% per year and your retirement's only earning 3% per year, aren't you losing 5% per year of the spending power of the dollars in your retirement account? Or am I crazy? Okay. Anyways, guys, you get it. I digress. There is a systematic approach to building wealth, just like there's a systematic approach to building fitness, muscle mass, losing body fat, getting rid of the beer belly. Same thing with money. It's no different. It's stoic. It's intentional. It requires you to pay attention to it and show up and do it, just like in the gym. Okay. So I hope this conversation helped. Again, I didn't have a subject to talk about, and this just spawned from what Andy said, which is, dude, if you're 40 or 50 years old, you're not really looking forward to your retirement because it ain't nothing. You ain't have nothing built. You see that your financial future is looking bleak. You're thinking, what the hell am I going to do when I'm 65? I'm not going to be able to retire. You're thinking also too, man, I wish I would have done something to give my kids, my grandkids a better life and that kind of stuff. Well, I just taught you guys within an hour or so a full systematic approach that, yes, wealthy people use. Of course, yes, wealthy people use these techniques. It's why they remain wealthy. It's how their family continues to get wealthier and wealthier, generation after generation. But it's not for the wealthy people. It's how the people became wealthy. It's not for wealthy people. These systems and these techniques are how these people and these families became wealthy. You understand that? So just because we're not wealthy, just because we didn't grow up with wealth, just because our parents and grandparents weren't wealthy people, okay? It's not where we're stuck. It's not the rest of our family tree that needs to be that same way. We don't need to perpetuate the same systems. We can come up with new systems, smarter systems, and yes, copycat. Just copy. Like we were taught in high school and college, copying is bad. Copying is bad. You can't look over at another smarter person's paper and then use their answers to pass the test. Ooh, that's bad. You can't do. Well, guess what? In real life and in money making, you can cheat. You can copy the cheat codes, right? You can look over at rich people and look at their paper and see what their answers are. And can't you just copy their answers? That would be kind of smart. So I've just taught you guys a couple of different things that people who are intelligent and wealthy people with financial intelligence use systems like this. They think of money differently. Right? We start to think of this fiat currency, and I hope I've helped your mind change today too. We help to think of this fiat currency as fake, worthless monopoly money. Just like the monopoly money, I can go into the closet right now, grab the Monopoly game down. You know, I can pull out a bunch of denominations of paper money. That is what our fiat currency is. The wealthy people completely understand this and have already been understanding this for years because fiat currency systems are cyclical and they always die. There's a lifespan to them. We just happen to be in the generation now, and it's about every 100 years, every 100 to 150 years, there's a new shift. Right now, we just happen to be in the generation where we are about to notice and see and be a part of the financial shift of the new financial system taking over for the next 100, 150 years. It's a financial shift right now from old fiat, unbacked promissory note printed currency that's just paper monopoly money in our wallets that the powers that be know is worthless. They know it's monopoly money, but they have the abilities to print as much as they want of it. If you had to print as much money as you possibly could, destroying fiat currency, creating hyperinflation, but you had the ability to print the fiat currency, print as much as you want, and then transmute that into stuff like Bitcoin and that, we see, guys. We see. It's always going to be this way. The powers that be, it doesn't change, right? As we know in the Bible, it says, pay to Caesar what is his and pay to me what is mine. So the powers that be and the government and paying taxes and all this other shit, it's never going to go away, okay? But we can do some smart things and put some systems in place to better ourselves while we're here alive and also to better our family's future financially. So you can be the change maker. You can definitely build a retirement within about a 10-year time period. You can become more wealthy, self-sustainable. You can have enough passive cash flow coming in to trump your bullshit Social Security or whatever it is they were promising to you. And you can live a wonderful, relaxed, retired life in your golden years like we're supposed to, not having to go take up a job at Home Depot or Walmart. No offense, but we don't want to do that when we're 79 years old if we don't have to. And then also just knowing and having the calmness inside you that because of some of these things you've set up during your lifetime, your kids, your grandkids, your great grandkids, and people that are going to be living a much better financial life than you ever did when you're long gone. So, of course, that old statement of the wise and stoic men, the wise and stoic men that are willing to go out there and do the work to plant trees that they will never sit under the shade of. You guys heard that? The wise and stoic men that are willing to spend their time and energy planting trees that they will never sit under the shade of. So one of these here principles I've taught you is exactly that formula. It will benefit you while you're here. Trust me, it will benefit you while you're here. But you can rest assured that when you're long gone, your kids, your great grandkids, and all that will sit under wonderful shade of these financial trees that you have planted for them. So guys, I thank you a lot. I definitely got soapbox today. I definitely got on it. Really didn't do much of a workout, but I am going to jump some rope. I'm trying to do some cardio. So after I get off here, guys, I'm going to do some jump rope for about 15 minutes, get a sweat up, get my calves activated in that, and then get to my day. Got to get to the office and got to, keep stoically trying to put these systems in place for my family, creating more cash flow, accumulating more assets, building more net worth, funding more and more cash value life insurance policies as I go into the Dynasty Trust, protecting the assets, protecting my family in a systematic and stoic approach. And AJ, dude, you said I'm crazy for giving myself all this for free and thank you and all that good stuff, dude. Listen, man, I appreciate people like you, AJ, that get value out of when I blab my mouth. Okay, honestly, I don't know it all. I'm not the smartest man in the world, for sure. I don't know it all, but certainly in 25 years of entrepreneurial endeavors, sales, and dealing with investors in all different categories, running startup companies, raising venture capital, all this other stuff, guys, it's just, I've learned a lot. Thankfully, it's been taught to me by other mentors in my life that were willing to take their time and were willing to teach me for free things that help my life. Were willing to take me under their wing when I was just a little shithead and I didn't know what the hell I was talking about or doing, but they saw some potential in me and thought, man, we could show this kid some things, okay? So if it weren't for those people in my life, I would not be where I'm at today, period, end of story. I didn't figure all this out on my own. I didn't go reading 1,000 books and doing a bunch of research on this stuff to learn it all. I had a lot of great people in my life, a lot of great mentors, and a lot of great direction that I've been given. So it is my pleasure to be able to come here to you guys and to offer some sort of information, blab my mouth enough to where at least hopefully in the hour and a half that we do these morning lives, you get something out of it. And hopefully I help change your mindset or I help spark something in you where you say, ooh, maybe I could start thinking a little bit different. And there is tons of hope, no matter what age you're at, okay? Obviously, if we're in our 20s, obviously, if we're in our 30s, we have the power of time is with us. The power of compounding is really with us. Boy, I'll tell you what. But it's not too late when you're 40 or 50 years old. Guys, think about this. We're living to 80 or 90 years old these days. We're living to 80 or 90 years old and we're saying, oh, we're 50 years old. Life's over. Oh, we're 50 years old. I haven't built up a bunch of wealth yet. It's over. Oh, what am I going to do? What was me? First of all, don't panic. Don't go doing risky shit and stupid stuff to try to catch up because you're not there. You're not going to go from not lifting weights and being totally unfit to benching 400 pounds. No, you won't. Okay. You have to work at it and use a systematic approach and show up every day and just keep this system going. And when you feed a system like this, eventually what happens is the system starts to feed you. Okay. So anyways, thank you guys for hanging out with me. Thanks, Chase, for coming in, dude. I know Chase is going to get into more, maybe thinking about mortgage note investing and some of these systematic approaches. So you guys are definitely welcome to come on here in the mornings and ask me different questions about stuff that I'm an expert at. So like tomorrow, if you guys want me to talk about notes for cash flow, tomorrow, if you want me to break down cryptocurrency a little bit more so you guys can maybe understand that, whatever it may be. But if you guys hit the subscribe button, if you haven't already, and hit the bell, some of you guys are already there. But I would love to have you guys on here in the mornings with me to discuss these kinds of things back and forth. I love your questions, man. And I feel lucky, AJ, that I have you guys on here supporting me. And I feel lucky that I can be blessed enough to maybe provide some value to your life, man. So I feel lucky to have you guys. So I really appreciate it, y'all. I thank you for sticking in. This was a long-winded one. I really didn't work out my legs too much, but I'm going to jump some rope right now, get my cardio going and get my calves activated. So guys, inspire you to either get up and get moving in the mornings, right? Let me inspire you to try to get in your best shape ever. It doesn't matter what shape you're in. That's what I'm trying to tell you guys. It doesn't matter what shape you're in physically right now. It doesn't matter what shape you're in financially right now. That doesn't matter. We are starting where we're starting. But if you can start to try to have a systematic approach, and you can try to have support systems, and you can try to have motivation and people there that are on the same mindset and same thing, we'll get ourselves in better shape over the next 2 to 3 years together. And we will be in the best shape we've ever been in our lives. I promise you it'll happen with a systematic approach. Also, too, same committed, systematic approach to our finances. We can turn things around, guys. If you really want to hit it hard, I can show you how you can become completely financially free, retire, and become completely financially free within a 36-month time period. That's a whole nother conversation. But anyways, all right, guys, I'm out of here. I'll get off my soapbox and stop ranting and raving and all. It's been fun. And you know darn well I'll be back here tomorrow morning, bright and early, and we can have another conversation about all of this. I appreciate y'all. Have a wonderful rest of your day. We'll see you tomorrow morning. Oh, yeah. Let's see here. That's right. So, like I said, it's been a blast. Yeah, bye, AJ. Thanks, dude, for coming in. Chase, let's go play some golf. Let's get together for lunch. What's up? It was awesome. Thank you, Bethany, for jumping on. To all the regulars that we had on here. Love you. Love y'all. I'll see you here tomorrow, okay?